Understanding Foreign Direct Investment. Foreign direct investment, or FDI, refers to a long-term investment by an investor in an enterprise in another economy, resulting in lasting interest with significant influence over the overseas enterprise. FDI typically occurs through mergers and acquisitions or setting up of business operations by the investor in a foreign economy. The investor is known as the direct investor, while the overseas enterprise is known as the direct investment enterprise. For example, when a company based in Singapore invests in an enterprise domiciled overseas, the Singapore-based company is the direct investor, and the overseas firm is the direct investment enterprise. The transactions captured will be recorded in Singapore's outward FDI. Conversely, inward FDI is recorded when a foreign direct investor invests in Singapore. How is FDI measured? FDI is measured by the sum of three components: equity capital, invested by the direct investor in the direct investment enterprise; retained earnings accrued to the direct investor, which are earnings generated by the direct investment enterprise after deducting the dividends payable to the direct investor; and net intercompany loans between the direct investor and the direct investment enterprise. FDI is typically positive, but in some instances could be negative, such as when the value of loans from the direct investment enterprise to the direct investor is larger than the loans from the direct investor to the direct investment enterprise. For example, a Singapore-based company's outward FDI in another economy in the ASEAN region will include the equity capital invested by the Singapore-based company in an enterprise in that ASEAN member state, retained earnings recorded by this enterprise, as well as net intercompany loans between the Singapore-based company and the enterprise. Let us visualize how FDI can change over time. In year 1, Company X, which is based in Singapore, invested $50 million in equity capital in Company Y, domiciled in a foreign economy, resulting in Singapore's outward FDI stock increasing from $0 to $50 million by the end of the year. In the following year, another $10 million is invested in equity capital, raising the FDI stock to $60 million as at the end of year 2. In year 3, Company X lends $40 million in intercompany loans to Company Y, raising Singapore's outward FDI stock to $100 million as at the end of year 3. With $10 million in earnings at the end of year 4 and dividends payable amounting to $4 million, the FDI stock at the end of year 4 stands at $106 million. What are the benefits of FDI? The host economy benefits from FDI through job creation as well as knowledge and technological transfers. For investors, undertaking FDI helps them build distribution networks and gain access to new technologies or natural resources. Singapore's inward FDI has grown considerably since the early 1970s. Foreign multinational enterprises have been actively investing in Singapore, which contributed to our economic expansion over the years. As Singapore's economy grew, outward FDI has become increasingly pivotal to our growth strategy. More companies based in Singapore internationalize to seek new opportunities abroad. For more information on foreign direct investment statistics, its related concepts and methodologies, visit www.singstat.gov.sg.